have a lot of order blocks, usually in a bullish trend, but we have what we refer to as high odds order blocks, also known as, or you can say, no, if I say high odds, it will look like we are betting over here. No, this is not betting. It's not gambling. So let's remove the high odds. Let's make it probability, high probability. When some people hear odds, they think of betting. High probability order blocks. Now, when we say an order block is a high probability order block, what does it mean? We have to know what it means. So when we see them, we know what is likely to happen. When we say an order block is a high odd order block or high probability order block, it means that when the market trades into that order block, it is very, very likely to reverse from there, or it is very, very likely to respect that order block. Let me take it. A high probability order block is an order block that price is very, very likely to respect. When I say price is likely to respect, it means that, let's assume that this is the order block, okay, somewhere here, and the market is coming from this side. It's bullish, coming from this side like this. It's headed towards the order block, okay? Then it trades into the order block like this. Now, what it means is that when the market trades into the order block, or maybe not into the order block, but just below it, touching the below of it, or touching the bottom part of it, or even trading into it, what a high probability order block means is that price is very, very likely, about 70 to 80% likely to respect that order block. Now, when we say price has respected an order block, what does it mean? It means that price was not able to trade above the order block like this. Or should I say it wasn't able to trade beyond the order block like this, but it's rather got rejected either within the order block or at the bottom of the order block, and then it started to move down. This is a bearish order block, okay? So there are a lot of order blocks, but not all order blocks are high probability order blocks. So you want to train your eyes in such a way that you can identify these high probability order blocks, because once the market goes towards that order block, that trade is likely to play out. Very, very likely to play out. So you must take note of that. Now, these high probability order blocks have certain characteristics. Now, as you already know, we have bullish order blocks and bearish order blocks. So let's look at the characteristics of a high probability bullish order block. Let's start with a bearish order block first. I'll do an illustration and then I'll explain. Now, but before I even do the illustration, let me mention one of the ways by which we can, or the major way by which we can identify a high probability bearish order block is that there are usually stops just under the bearish order block. Stops. And I believe you know what stops are. When I say stops, I'm referring to equal highs, double tops. That's what I mean by stops. Or old highs, equal highs, double tops. That is what I'm referring to as stops. Okay? So how does it usually look like? Let me do an illustration. Then we'll go to the main chart to look for example. Let's say this is price doing S10 like this. Then the market comes down and decides to go back up. Now, it's going back up. Observe something. Initially, the market was bullish here. This was a bullish run. Okay, that was a bullish run. A bullish run, a move upwards like this. We can see an impulse swing to the upside. Then there was a reversal here. We saw the market begin to reverse somewhere here, and then it started coming down. Okay, now this was a point of reversal. Now we have realized that the market is trading back upwards towards where it previously reversed from. That is this zone. But then right above, so this is a double top formation. And I've told you severally that double tops are not places where you should be taking trades. You should not be selling at double tops, because the institutions know that many retail traders are selling at these double tops. And if retail traders are selling at these double tops, they have their stop losses just above those double tops. And for most traders, the range is 10 to 70 pips. Just few traders can hold trades over 100 pips and loss. Most traders can't. So most traders have a stop loss of about 10 to 70 pips maximum. And they know that range. Okay. So This, according to the knowledge out there, is a good sell setup, the double top formation, and it's true. It is supposed to sell from there, but because they know that a lot of people are selling there and have their stop losses above, they usually run the market above those highs to clear everybody that was selling there and set their stop loss above, to clear them before they drop down. Now, once you see a double top formation like this and you see the market trading upwards towards that direction, then you look above that double top, this one, and then you see a bearish order block there. Let's say this is the bearish order block. This rectangle is the bearish order block. Okay, that is the bearish order block. Let us extend it to the right. So the market is what? Moving up towards that bearish order block. Now, when it gets here, where this horizontal line is, don't sell it. Those are double tops. It's a trap. If you are selling from here, anybody that is selling here has their stop loss somewhere here, this zone. So they have to go up to clear those stop losses before they come down. Okay, so if you look above those tops and then you see a bearish order block there, that bearish order block is a high probability order block. There is a very great chance that once they clear the people over here, they are moving up and trading into that bearish order block before they start to drop nicely. So while the less informed trader is selling at these double tops, you should be selling at the bearish order block just above those tops. That's why I'm saying for a high probability order bearish order block, we have stops just under the bearish order block. Now these are the stops. These double tops, they are stops. When we say stops, we are referring to double tops and highs, equal highs, or double bottoms and equal lows. So you have the bearish order block that is just above these stops. So what you have to do is to wait for the market to trade above those stops and then clear the liquidity there, then trade into that bearish order block. So as the less informed trader is selling from here, you are rather targeting to sell from the bearish order block. So that is how a high probability bearish order block looks like. Now I want to be sure that you understood my illustration. Okay, I'm getting positive feedback. So what we do right now is we are going to go to the live chat and look for examples. We'll come back and look at this example when we are talking of high probability bullish order blocks, because this is a perfect example. This is a trade I actually missed, and up to now I am biting my teeth because it's a very, very nice setup. I should have placed a pending order. I forgot to do so. And from where I wanted to buy it, it's been going up for 146 pips. Very nice setup. So let's look for what I was talking about. Then we continue. They are quite common. I'll do my best to identify a lot of them. Is this one? Yes, I think so. Now look at something. This is a bearish order block. I like to see these things on the bigger time frames. When I see them on the bigger time frames, I'm happy because it means that it's a big money move. But this is not a perfect example. Let me look for a perfect example so I can show you. Because it's the first time I am introducing it to you, I have to look for a perfect example for you guys. Is this one? The market trade back to this level? No, it didn't. Let me scale it to the daily time frame. Yes, this is a perfect example. Now look at something. Let me zoom in so all of you can see. I may have to take off these drawings for now. Now, obviously, this is a bearish order block. The last bearish candle before this move, before this, the last bullish candle before this sell, or this swing, what you impulse swing to the downside. That's a bearish order block. Now, look at something. These are stops. This is an old high. When we say stops, they are double tops, double bottoms, equal highs, equal lows, or old highs. This is an old high. Okay. It's an old high. So you can see that the market traded above it. Let's place a horizontal line and extend it. You can see that the market traded above it. Okay, and just above it, we have a bearish order block. The market didn't exactly touch the bearish order block, and that is because we have a gap here, which we'll be looking at on Friday, how to identify these gaps. So after filling the gap, they just decided to go down. They didn't trade into the bearish order block. But this is an example. I'm looking for an example where there were double tops or equal highs, and yet they traded above and into the order block. I think we will see some very soon here. Someone is saying, what is an old high? An old high, a high that is old. As simple as that. This is a high and it's an old high. I think there's a nice example. Look at this. Look at this bearish order block. This one. Let's extend it to the right. So let's assume that you saw from here that the market was going up from this point. Okay, it was going up, and so you're looking for sell opportunities. These are equal highs, relative equal highs, because they are not exactly on the same level. I'm referring to this high and this high. They are relative equal highs. The difference is marginal. So you extend it. Okay. Can you see how they traded above those highs? This is what I'm talking about. I'm talking about these relative equal highs. See how they traded above it, traded right into the bearish order block before they started to sell. So if you sold from here because you thought this was an equal high, that looks like, if we go to the smaller time frames, it will appear as a double top, and you decided to enter the trade from there, you would have had a drawdown of 143 pips. I don't think you hold your losing trade for that long. 150, it's even 152 pips. You would have waited for them to clear those highs before. Now they cleared those highs and they traded into the other block before they started to drop. Now somebody asked me a question the other time that after they have taken out those highs and they've traded into the other block, should you start selling? Because he realized that sometimes when you sell, the price continues to go up and then trades a bit high. So if you sold from here, you will be in a big drawdown. Now, to solve that problem, after they have cleared the highs and then they start to trade into the other block, if you are seeing this on a big time frame, like a daily time frame, switch your chart to 1 hour, 30 minutes, or 15 minutes. Observe those 3 time frames and look for a break in market structure in the form of an M pattern like this. Now, once they trade into that bearish order block, and then you see an M structure like this in 1 hour, 15 minutes, or 30 minutes, okay, and they trade back to the midsection of the M, that is when you should sell. The break in market structure will appear on a smaller time frame. If you want to avoid a big drawdown, scale down to the smaller time frames, 1 hour, 30 minutes, or 15 minutes, and look for this structure. Once you see this structure form, and then they trade back to the midsection of the M here, like this, you should sell it. That way, you will not get a huge drawdown. Yes. So that is something you can do. That is what you should be doing actually. So if they decide not to trade into that bearish order block and they come for the bottom of the bearish order block, you can still scroll down to or scale down to those smaller time frames and still look for this structure. Once you see this structure forming, it's telling you that the market is ready to what? Change trend. So you get in on those sales and they are very likely to make profits from that trade. Let's look for another example of a high probability bearish order block. Okay, look at this example. Let me zoom in. Now look at something interesting is happening here. This is Euro USD. If you look over here, these are equal highs. Let's draw them so you see. These are equal highs. Can you see them? Now right above those equal highs, what do you see? Bearish order block. This bearish order block here. This is a high probability bearish order block. In future, if Euro USD decides to trade back up, they are likely to clear these highs and then find resistance in that bearish order block, then drop. So this bearish order block here is a high probability bearish order block because of these equal highs resting. These equal highs are known as stops. So in future, if Euro USD trades back up, it's likely to go clear these equal highs because that's liquidity. Then trade into this bearish order block before it does what? It drops nicely. So this is exactly how a high probability bearish order blocks look like. They are usually equal highs or double tops, okay, or old highs below it. The old high could be just one, and these are usually situated below it. So you wait for them to clear that liquidity, and then once they get to the order block, you can take your trade from there. Do you understand? Let's see if we can find one more example. Then we'll look at the bullish one. Good, good, good. This is a very nice example. Look at something. Do you see this bearish order block? I'm referring to this one. That bearish order block formed on 14th May 2012. Then it gave us a very nice sell opportunity sometime on 29th September 2014. Look at something. Look at these equal highs, relative equal highs, actually. Okay, this is actually an old high. This is what I'm talking about. These are stops. Now, when you see an old high or equal highs below or beneath a bearish order block like this, let's extend it. It's a high probability bearish order block you're looking at. Wait for them to trade above that old high and then trade into the bearish order block. Then you take your trade from there. So this is one of those examples I was talking about. You can see that this bearish order block, price traded through it, over 50% of it. Now you see later, it couldn't hold price traded above it. Once price goes through over 50% of a bearish order block or a bullish order block, that order block is no longer strong. It becomes weak. So in future, when price trades back into it, you should not be too optimistic that that order block will hold. Reason is price previously traded through over 50% of it, so it's probably weak now. Now look at how they cleared these highs and traded into this bearish order block. If you sold from here at the bottom of the bearish order block, price would have gone up 545 pips against you before finally trading in your favor. So you definitely would have lost this trade. So how can you be safe? Go to the smaller time frames until you see this structure. Don't sell until you see an M. It could be any of the M's I have taught you. Until you see something like this forming and goes back to touch the midsection of the M, don't sell. That is if you want to be safe. So what I want us to do is I want to highlight that portion. Then we'll go down to a smaller time frame and see what happened. We'll go down to 1 hour, or even we can start from 4 hour. Okay, this is a weekly time frame, so we can even start from let's start from 4 hour. So let me place a vertical line there so we can trace it back. That was somewhere in 2014. Let's go to 1 hour and see how it appeared over there. Okay, this is it right here, 29 September 2014. So let's look at 1 hour. So let's go to 2014. See what happened. Can you see what I'm seeing? Do you see the M structure? So it means it will have required a lot of patience for this trade to be executed. Look, this is what I'm talking about. This was a break. Where's the retest? The retest came somewhere here. So this is a big move you would have spotted, but it would have taken a long time for it to play out. Can you see what I'm talking about? Do you see the M structure and the retest of that structure? Good, you can see it. So that is what I'm talking about. If you see it on a weekly time frame, it will take a long time for it to play out. Okay? But if you know the trend of the market from the bigger time frames, and then you see something like that on a smaller time frame, then you can get them on yourselves. Okay, this is an example. Look at these equal highs. Look at the bearish order block. You see they traded above those highs, they cleared those highs, those equal highs. Those equal highs are a form of liquidity. Then they traded into the bearish order block. Before they did what? They started to drop. So let's take note of the date and go and look at it on 1 hour. Alt plus G. That was on 15th May 20. Let's look at the opposite one. Order block. How to identify a high probability bullish order block. Because I believe you understood the other example. I just want you to know how to look out for it on the smaller time frames. So you enter at the right time. So you don't have a long drawdown. Because if the drawdown is too long, you get out of the trade, you close it in losses. And that is how to identify high probability bullish order block. So the market is coming from above like this. Then we have a double bottom formation, something like this. The market goes up. And this could be any time frame. Okay. Then it finds resistance here. It's coming back down. Now you know that it's coming back to support. So you are looking for what? Buy opportunities. These are our double bottom or equal lows. Below those equal lows, there is a bullish order block like this. That's our bullish order block. So what is likely to happen? They are likely to trade below these equal lows, clear the liquidity, then come to find support on this order block and start to go up. So this is a high probability bullish order block. Resting, so that one you have double bottoms or equal lows resting above that bullish order block. When I say stops, I am referring to double bottoms, equal lows, or an old low. So for the high probability bullish order block, you have stops just above the bullish order block. Okay? Above the bullish order block. That means that the bearish order block, the bullish order block is just below those double bottoms or equal lows. So you wait for them to take out those equal lows or double bottoms and trade into that bullish order block. Then you buy from there. We have an example here. Now look at these equal lows. Let's extend it. Can you see how they traded below the equal lows and traded right into the order block? Look, that's a bullish order block. Then they started going up. They always come down to clear these equal lows. Now, when you go into a smaller time frame, these equal lows will actually pay as double bottoms. That's why I keep telling you, don't buy from double bottoms, because anybody that bought from there would have had a drawdown of how many pips? Let's calculate. 61 pips. That's quite significant. 61 pips drawdown, that's quite significant. But if you took the trade from this bullish order block, okay, you would have had 25 pip drawdown. Better still, if you want to be safe, once you see that price has traded into the bullish order block, scale down to the smaller time frames, 1 hour, 15 minutes, or 30 minutes. Look for this structure, this W. It could be any of the W's I have taught you. I'm always happy when I see this on 15-minute time frame because it doesn't take long to play out. So this should be your point of interest. So you buy from here on the smaller time frame. This is where you should be looking to enter the market, right here. So we are coming to go down to the smaller time frame and see what happened as far as this pair is concerned. Then I'll place a vertical line right on it. That's today's candle. So this should be easy to identify. Let's look at it on 1 hour. Then we'll also look at it on 15 minutes. Okay. Do you see the W structure on 1 hour? Just that it hasn't come back yet to retest it, but I believe it did on 15 minutes. Let's look at 15 minutes. It's yet to come back to that W it formed on 1 hour. So in future, if it comes back to it, that could be an opportunity for you. That is likely to happen next week because I don't see this thing coming down here and going back up this very week. That's likely to happen next week. So if the market trades back to this level sometime next week, a very ugly W, this could be a point of interest to you right there. Now let's look here if there's any gap. I don't see any gap here, so they are not likely to come here, but it's possible because there's a bullish order block here. They can still come for this bullish order block before they go up like this. Let's look for another example. I want a perfect example for you guys. Let's go to daily time frame. Did it trade into it? Just touched it. Wow. Look, do you see how they are moving up aggressively to go and clear these equal highs? That is liquidity resting right there. They want to go up to clear it before they drop. Interesting. Let's look at USD CHF. This one doesn't have what I'm looking for. Okay, look at this example. This is a bullish order block, right? But before that bullish order block, look here. What do you see? Equal lows. That's liquidity. So can you see how they came down to clear that liquidity before they traded into this bullish order block and then they started to go back up? Now, let us look at this on 1 hour and see. This is a daily time frame. Let us look at this on 1 hour. This is where the whole thing started. We are likely to see what I'm talking about. Exactly. This is a perfect example of what I'm talking about. Look, you see? So you could have waited to see this structure before you took your trade. You went up, traded right back into it. This is a midsection of the W I'm talking of. You see? They traded into it twice. So let's say you took the trade upon the second entry or even the first entry. Okay, let's use the first one. The first touch, sorry. If you entered the trade from there, you would have had a drawdown of just 5 pips. And it went up for how many pips? 61 pips before it retraces back down. So you have to train your eyes to identify these structures, the M's and W's I taught you. When you see that the market is trading into a bullish or bearish order block on a bigger time frame, and you don't know if you should enter immediately, you can wait, see a break in market structure in the form of M or W, depending on whether the market is bullish or bearish, before you take the trade. Do you understand me? That is how you can be safe. So let's look for high probability order blocks on GBP USD and then see what happened when the market traded back. I have too many boxes on this chart. Let's say you know that the trend is bearish from the higher time. Then the market goes up to clear highs and then trades into a bearish order block. You should be selling. A high probability bearish order block. Look at something. This is GBP-JPY. Look at these highs. They took out these highs. They also took out this old high. Then what did they do next? They traded into this bearish order block. Look, a very long bearish order block. They traded into it, then they dropped down. They gave you a break in market structure and a retest. Look, there's M, the second type of M. Look at it right here. Then traded right back into it. You see? Can you see what I'm seeing? Then they dropped. So assuming you caught this trade from here at the midsection of that M and you held it till they came to clear these lows, you have made 55 pips trading the daily cycle. So that's how you identify high probability order blocks. Yes, I think there's another one here. Very good. Look, I believe you can already see it. Look at the equal highs they took out. You see? Can you see the bearish order block above it? So they traded up like this, took out the equal highs, traded right into this bearish order block. And then what? They even traded into it twice. Then they dropped. So let's say you caught this during London session. You would have held this trade till what? London close. Don't hold the trade beyond the close of that session. So if you caught the trade during London and by New York, you are in profit, you should close it. Even if it has given you just 20 pips, close it, because when New York comes, there's a likelihood that it could be a reversal. So that's how simple it is. So this is a high probability bearish order block. Assuming you caught it here, how many pips would you have made? 64 pips in a matter of hours. Perfect. You are done for the day. Let's see if we get another example. Yes, there's another example here. But this one didn't play out well. It didn't get to the bearish order block. It tried its best, but it didn't get to it. But that we could have still caught this trade. Look, another thing I should tell you, if you're expecting them to trade into a bearish order block for you to sell, and they don't get to that bearish order block, but then you see a break in market structure and a retest of that break, take the trade. This is a perfect example. Look, they took out these highs over here. They were supposed to trade into this bearish order block, but they didn't. Then later, what did they do? Look, is this not an M structure? Can you see the M structure? Let's draw the midsection of that M structure. You see, they traded right back into it. So these M and W structures are very powerful. Learn how to identify them on your chart. And you can only learn that through practice. They touched it, then they dropped. For how many pips? 116. So they didn't touch the order block. They are taking out these highs, but they didn't trade into the order block. Fine. But you have seen a break in market structure in the form of this M. M plus retest of the midsection. So the midsection of that M right here, that should be your entry. You see, like here, you would have entered here and it went down for over 100 pips. So it's simple, okay? You just have to spend a lot of time on the charts, doing your best to identify them over and over and over. The more you identify them, the better you become at them.